Hello again, lovely viewers, and welcome back to episode 7 of the investment journey. This week we'll be speaking about stocks, and more specifically, we've spoken about them. You want to buy them, they do good returns all quarterly, all year roundly, but how to find the stocks you are going to buy in the future? That's the question, because everybody tells you, yeah, buy these stocks, something's going to happen, they're going to have enormous profits. Or on the other hand, they tell you buy cryptocurrency, which is stupid, so don't. But this week we'll be speaking what specifically you need to look for when you look for stocks, where to look at this data, where to find it, why you should find it, and what it means. That is what we'll be speaking about today. And if you want to know more, sit back, relax, and tune in to the video. I hope you now are buying mutual funds and know what they are about, and you like them as well, hopefully. But now, why would you buy stocks? Stocks are also a very good investment decision and product which can give you abnormal returns. Mutual funds can vary between 2-3% return yearly to maybe 20 in some very good years. Stocks, on the other hand, if you choose them right, can give you abnormal returns, and I'm meaning 100% plus value on your portfolio. But how to find them? That's the question, and now we are going to do that. But before it, again, if you like what you're seeing, please do subscribe to the channel, write your opinion in the comments, and as always, gently press the like button. Thank you very much for that. So, what do you need to look for when you're looking for stocks? I usually use, as you can see here, Nasdaq. Pretty simple. You can use and look for most of the famous and not so famous stocks. It's great. So you write the name of the symbol or the name of the company, you click on it, and then all this information will come here. So you can see the stock price, you can divide it by days, years. You need to look at that, it is interesting. But very interesting information which you need to see is that one here and on the bottom. So the three key things which I look for when looking for stocks, except common knowledge, is firstly, you do go down here and you can see it's called earnings per share. What does that mean? Earnings per share is basically the profits which the company has made this year, divided by the number of shares existing. So there are a lot of shares or stocks, it's the same word. So the net profits divided by the shares give the EPS, earnings per share ratio. What does it mean? The earnings per share ratio means that if it's high, then it could be a very valuable company. Why? Because the investors will pay more for this share because they think that the company has, let's say, higher profits compared to the share price. So if a company has a high EPS, it means that is a good value most of the times. Secondly, what do we look for? We look for P to E ratio. Right here it is 29. P to E ratio means basically the share price which the company has. So for Apple we have 130 right now. So it's the share price divided by the earnings per share, which we spoke about now. So if the P to E ratio, which for Apple is 29, is high for the company you're looking for, 29 is considered high. So it's double digit, it is high. So if the P to E ratio is high, it could mean that the company is overvalued or that the investors who invest in that company expect future growth. So it's a double-edged sword. Is it overvalued? Is the share price going to fall? Or is it expecting growth? You need to think of that for yourself. But if you're not that type of a risky player and you want to know that the company is a value stock, not only growth and risky one, you need to look, in my opinion, it is not shown here, but you can check it on other sites or in all of the information here if you click it. It's the price to book ratio, in my idea. So it is basically the market value of the company. So market valuation as it is, depending on the Nasdaq or the New York Stock Exchange, divided by the book value of the company. By book value, I mean all the assets minus all the liabilities of the company. That's the book value. And if that book value is smaller than 1, it means that it's a solid company, it is not overvalued, and it's a very good investment for somebody who wishes to have value stocks. Growth stocks, on the other hand, not so much. What else? You need to see here, a very important tab, in my opinion, is the analyst research tab. So we want to keep on this channel things simple. You're not going to be a professional, I'm not a professional myself. So you go and see what the professionals say. So all of these here are investment analysts, stock analysts, which basically analyze the stocks. And all of their people who are doing with their fancy education degrees and doing all the analysis on these stocks, every couple of months put a valuation target. For Apple, it is strong buy based on 12 analysts in the last 3 months. What can that tell you? That can tell you that Apple is going to grow in the future, which, to be honest, it's pretty simple to the mind. Apple is a very good company, a very big company in my opinion, so compared to the analysts, it would grow. So you need to check that section, see what the smart big boys are telling you, and decide for yourself if you're going to follow this advice. It could be hold the rating, it could be sell, so they can help you with that. And down you can see their average prices which they have given. So the average price for Apple, all the analysts give it 160. You go up, you see it's 130. So it's below the average of the analysts. That could tell you that probably and hopefully the Apple stock will grow. The high rating is 185. That's a lot of percentages growth. We don't know if it's going to achieve that, but if the actual value of the stock right now is lower than the average, common knowledge could be that it's a great buy. So these things you need to consider. Of all the things you can see on Nasdaq or all the other sites where you can see stock prices and stock quotes. But these are, let's say, the more complicated ones. It's good to be considered and it's good to use them. But in my opinion, far better is to use your brain. That's at least how I do it. If I use my brain, usually I get big returns. My portfolio is, let's say, very profitable the last year, and most of the things I've done are pretty simple and are based on the fundamentals. So, what are they? What do I mean when I speak about fundamentals? So, I usually do not search for my own stocks. I follow a couple of investment magazines and websites. One of them is the Motley Fool. I follow Nasdaq, which uses a lot of their articles. That's an advertisement. I'm not sponsored or anything, but they're good and I use them. And after I read the articles about interesting stocks in which they think you should invest, I do my own research, like I've shown till now. I do that. And then, as I spoke before, I use my brain. What do I mean about that? So, I started investing last year in January. So, in March, the crisis around the world hit the country which I am currently residing in, which means that I started thinking, what is going to happen when everything shuts down? So basically every physical stock, let's say airlines, restaurants, cars, manufacturers, whatever, it's going to shut down little by little, not that on the car manufacturing side. And all the technology stocks, AI, intelligence, cloud software, whatever, are going to go up. And then I decided which are the big players and went with them. And of course I did some risky bets on some more of a startup-ish like stocks. So you need to think and assess the opportunities. Depending on when that video is right now, a thing which I thought about was all the car manufacturers around the world are in need of more chips so they can finish their cars. And that struck my brain and said, okay, so there are not enough chips around the world. Volkswagen, Ford, all the big manufacturers are not producing hundreds of thousands of cars because of that. What can it mean? All the semiconductor and chip manufacturer stocks and companies are going to grow. And I decided, checked around which stocks are the biggest, which I think have bright future, and bought them. And we'll see after 1 year if my decision was correct. I hope you can do that. And basically it's not that difficult, it's simple, just take the decision and don't think of your money as, oh, am I going to lose them, am I going to lose them? Most probably not. Basically, for you to use the money when you buy a stock, that stock needs to go bankrupt. So if you are too scared to invest in more not so solid value stocks, buy all the big stocks. Again, not investment advice, but I'm telling you what I would have done. Buy Apple, buy Microsoft, buy Google, buy Facebook, buy Snapchat even, buy Visa, buy big airlines, buy companies which have been here since you have been alive and are probably going to outlast you. Then you can still achieve good growth, but not take that risk, not take the risky side that much. So that will be briefly about that. Furthermore, in the investment journey, we'll be showing how to choose a stock and then how to buy a stock and what are the associations which you need to have when you are doing this process. So this is a brief description of how you can try using the internet to look and then think about stocks. What will be a good investment decision? Later down the track, we'll show you more. I hope it has been a pleasure watching that. I'm sorry if I made some, let's say, vocabulary mistakes. It was not my knowledge, but I'm a little bit anxious about this video, so I hope it has been of great help to you. Anyway, I will see you next week and thank you very much for watching. Bye bye.